BlackRock and Vanguard are one of the biggest companies you've probably never heard of. If they were a country, they would be the third largest economy on the planet, after the United States and China. BlackRock and Vanguard are two major players in the world of finance and investment. It might sound impossible, but BlackRock and Vanguard collectively manage $17 trillion. According to MarketWatch, there is currently around $40 trillion in circulation around the world, and it might sound impossible, but BlackRock and Vanguard collectively manage $17 trillion, more than 40% of it. But how did BlackRock and Vanguard become the largest asset manager in the world, and what does it mean for the current and future world economy, and which among the two is the real boss?
We have now $7 trillion in money market funds.
Vanguard, BlackRock, how much have you looked at what they're doing? They're pretty much running everything.
Yeah.
Buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one.
Let's have a look at their business models. Imagine you have some money, and you want it to grow over time. You've heard of two big companies, BlackRock and Vanguard, that can help you do this. They make money by helping people like you invest their money wisely. Think of these asset management companies as financial experts who offer different ways to invest your money. They have something like a toolbox with various tools or investment options inside. These tools can help your money grow. Now, to use these tools, BlackRock asks for a small fee, like when you hire a professional to do a job. This fee is how they make their money. For example, let's say you invest $10,000 with BlackRock, and they charge a fee of 0.5% per year. That means they'll take $50 from your $10,000 investment each year. They use that money to pay their experts and use advanced computer systems to keep an eye on your investments. It's like hiring a skilled gardener to make sure your money garden grows well. Before moving on to the comparison, let's have a reality check about the power and influence of BlackRock and Vanguard. There's a widespread belief that BlackRock, Vanguard, and to a lesser extent, State Street, control the majority of major corporations. This comes from the observation that these firms often emerge as top shareholders in many companies. According to a 2017 report from Cambridge University, these three firms were the top shareholders in 88 of the S&P 500 companies. Collectively, BlackRock and Vanguard manage approximately $17 trillion in assets. However, this doesn't mean they own a third of the U.S. stock market, even though the value represents about a third of the U.S. stock market's capitalization. In reality, while they manage trillions of dollars, that money belongs to their clients. BlackRock and Vanguard are primarily asset managers, meaning they take client money and invest it on their behalf. For instance, of BlackRock's $10 trillion in assets under management, they themselves only own $123 billion. These big companies have a lot of money from clients to invest, but most of it isn't actively managed, it simply follows the ups and downs of the stock market. So, they don't have full control over where to invest. For example, out of BlackRock's $9.4 trillion, they only actively manage about $3.2 trillion, and for Vanguard, it's even less. Their real influence comes from voting on important decisions in the companies they invest in, like who gets to be in charge. For example, when big companies hold their annual meetings, BlackRock and Vanguard get to say yes or no to things like executive pay or environmental policies. This can nudge companies to make more responsible choices. They also help make investing simpler and cheaper for regular folks, which is pretty cool. But they don't have a magic wand to control everything. It's more like being a trusted advisor in the world of finance. For example, back in 2008, when the financial world was in big trouble, the US government asked BlackRock for help. They wanted BlackRock's advice on figuring out what to do with struggling assets, like homes and loans. This showed that BlackRock is a big deal in finance and that their opinion matters. BlackRock and Vanguard share the same goal of multiplying your money for their share of it. They adopt different strategies and have different areas of expertise. Let's first talk about the investment options they are offering. Looking from an investor point of view who is looking to make a diverse portfolio, BlackRock clearly has a bigger menu of investment options. It's like walking into a supermarket with aisles filled with every possible grocery item. That's BlackRock for you, especially known for its iShares or ETFs. An ETF, or exchange-traded fund, operates a bit like a basket, collecting a variety of stocks or bonds. It's like buying a little piece of a whole bunch of companies with just one investment. The beauty of an ETF lies in its flexibility. You can buy or sell it on a stock exchange just like a single stock. BlackRock's iShares encompasses everything from sector-specific assets, such as technology in Asia, to thematic elements like green energy companies in Europe. Vanguard, while offering a more focused selection compared to BlackRock, presents a robust array of investment options designed with precision and purpose. Their cornerstone remains index funds, providing a reliable, market-matching strategy favored by many long-term investors. Alongside these, Vanguard offers a suite of ETFs, actively managed funds, fixed income solutions, retirement-focused options, and sustainable investment choices, accommodating a diverse range of investor preferences. Vanguard has a smaller portfolio, but it is for a reason. BlackRock and Vanguard have difference in their investment philosophy. Think of BlackRock like a team of financial experts who use a mix of strategies. Some of their experts actively try to make investments that do better than the average, while others simply follow the overall market. They use fancy computer tools to help them make smart decisions and manage risks. Vanguard's founder, John Bogle, believed in the philosophy of buy and hold. Vanguard believed that, over time, the entire market tends to grow, so they offer ways for you to invest that just follow the market's growth. They don't try to beat the market, they want you to grow your money by simply being part of it. And they do this while keeping the costs really low, so you get to keep more of your money. Which brings cost effectiveness into discussion. BlackRock is like a high-end boutique. You pay a bit more, but you get specialized items like specific ETFs. BlackRock offers a diverse range of investment options, but often at a cost. Investors pay fees for the services provided, which contribute to BlackRock's revenue. BlackRock's actively managed funds typically have higher expense ratios due to the active management and research involved. On the other hand, Vanguard is well known for its commitment to keeping expense ratios low, ensuring more of the investor's money is invested rather than spent on fees. Vanguard is like a wholesale club where buying in bulk or investing long-term tends to be more cost-effective. Their average expense ratio is 82% lower than the industry average, ensuring that more of investors' money stays in their pockets. They've saved investors approximately $175 billion in fees since inception. This cost advantage has been a significant factor contributing to Vanguard's popularity among cost-conscious investors. However, to grow in popularity, both companies need to innovate and evolve constantly. As Steve Jobs said, innovation distinguishes between a leader and a follower, and this is where BlackRock is miles ahead of Vanguard. Have a look at the business model canvas of BlackRock. The secret to success of BlackRock is this: Aladdin. This digital brain or advanced trading algorithm has been shaping global markets for decades. The extensive technology program, which, by some estimates, operates more than $21.6 trillion in assets, was created by Fink, the CEO of BlackRock, and several colleagues in 1988. Aladdin executes trades in every asset class across every industry and directs the actions of the Federal Reserve and almost every major U.S. bank. It controls over half of all ETFs, 17% of the bond market, and 10% of the stock market. It collects data points on every market, every company, and every asset, and uses machine learning to calculate which trades to make in less time than it takes for your brain to send an electrical signal through your nervous system to your fingers. BlackRock is considered by many as the Silicon Valley of the investment world. It continuously pushes boundaries by seamlessly integrating technology into its core strategies. On the other hand, Vanguard's approach to innovation and strategy is akin to a master chess player. It might not make the flashiest moves, but every step is calculated, methodical, and grounded in timeless principles. Vanguard's core philosophy is rooted in long-term, value-based investing. Bogle was not just an investment maverick, he was a visionary. He realized that while the allure of short-term gains could be tempting, the real treasure lay in the long game. This ethos gave birth to Vanguard's signature index funds, which, rather than trying to outperform the market, aim to mirror it. Vanguard ensures that their clients are not just investing but understanding and growing. It's like comparing a cutting-edge electric car to a reliable, fuel-efficient sedan. Both get you to your destination, it's just a matter of preference.